the MBA, who actually administered the rules with respect to companies, law, registration barriers, and valuation rules. So he also has authored two unique books on valuation, titled as Business Valuation in India Beyond the Numbers. So I welcome Mr. Sawhney again to the discussion, and looking forward for a really engrossing session. Mr. Sawhney, over to you.
I would like to acknowledge Mr. Natraj's effort. Today's topic and the speaker, was referred by Mr. Natraj. Thanks a lot from BVA to Mr. Natraj.
Thank you. Thank you. My pleasure.
Yeah. Good morning, everyone. Can you hear me?
Yes.
Yeah. So my sincere thanks to the BVA team, and you guys are doing a pretty good job. The best part I don't know best or what should I say, but early morning and 7:30 you have to take a session. I was a little apprehensive of the session, whether people would like to attend it, because but luckily the topic is something which we are doing in our day-to-day life. So this is something which we connect with, the valuations, merger and acquisitions, and these topics are more important in the present times because the world order is changing now. So it is not that, the strategies which used to work 10 years back, 20 years back, they still work. We have seen this COVID pandemic, and, we have adapted to these new things of webinars, Zoom meetings. All of these things are, online. So the world order has changed, and the companies also need to change. We are seeing that there are different perspectives which we are seeing for quite some time. Like when COVID got slowed down, then we have seen that till about December last year, there was significant activity that was increasing. Even till March also, post December, January, February, March also, the activity remained on the uptick. But the last 2 months have been a little worrying because of, the geopolitical tension. Nobody presumed about Ukraine situation. The rising interest rate. Recently, you would have seen RBI has just jumped on the interest rates, because in earlier the stand was that, when US government is increasing the interest rates, that means the Federal Reserve of the US is increasing the interest rate. Then there was a statement from our Indian RBI governor that, India is a different story and probably we need to support growth rather than increasing. But then suddenly, we have seen that a 40 basis point hike was announced very recently, and maybe expect 100 basis point hike very soon. So again, we are going back to the older interest rates. The inflation is at all-time high, right? Russia conflict has not yet got resolved. So there are jitters in the market, right? You would have seen startups. Like I'll take you through the presentation, but I thought let me just share my perspectives before the presentation. So you understand the economic situation we are in. I mean, we were always, and you people are from Bangalore, I'm from Delhi, and Bangalore is the tech capital. So there is all technology, all companies, large companies. You would agree with me, the cost of these employees, if you want to hire technology people, it is almost difficult for a non-funded startup to hire them, because they are not only expecting huge amount of salaries, but something which actually is the expectation which a smaller company cannot give is an ESOP. So they are actually expecting the entitlements in the company shares. And because that has been the market trend, all the leaders have done that. So what has happened that, the talent becomes scarce and very costly. But recent news, if you look into, I mean, companies have been closing the businesses because capital is drying up. Companies again are reducing the employees. They are focusing on core competencies. And what happens in these kind of situations typically is that a lot of M&A happen, because not every company is going to get the capital. And so there will be scaling of resources. There will be, because right now, when a startup starts, then, one way of looking at it is that can we do something that, we scale at any cost. So the idea is that we have to increase the business, we have to increase the GMV, and that is the basic thought process and not the profitability. And, we have seen this happening in the past as well. So it's not that this is happening for the first time. So the 2008 crisis, has stories for us, has learnings for us. The 2018 situation again, has learning for us. And now we are in 2022. So we have to go back, we have to look that how the industry has adapted at that point of time. Situation may not be, I'm not comparing 2008 and 18 with 22, but I'm saying that there are some aspects because of which the trends can be seen and the trends can be analyzed. So with this, I think I'm starting my presentation. And because it's early morning, I said, all the videos are off. Only my video is on. So anybody who wants to ask anything, yeah, please ask, so that, I also remain, I came back, 11 o'clock yesterday. So again, I need some encouragement to be alive. So feel free to talk to, raise your questions, right? Anything more than questions, it could be a discussion, because you people are already doing this stuff. But we can have some discussion and we can share some experiences. The idea is to keep it involved in this, right? So my slide has changed. Yeah. So I'm starting with the startup and funding trend. A few of the things which I just mentioned, I'm just starting with that. So see, what happens here is that I have just compared the April number, because what has happened that till March, the activity was growing. If you look into that, like just to give you a small number, then in April, there was Indian startup had raised $2.65 billion. And the same number in March was $4 billion. May number is still not out, but I am definitely sure that it will be much, much lesser than $2.65 billion. So the thought is, if you just Google out on startup, and, there are so many reports, so many institutions. In fact, Sequoia has sent a detailed thought process. Sequoia's leading partners have sent their thought process to all the portfolio companies. The idea of sending that thought process was that, you need to conserve capital, and you cannot expect easy capital in this period of time. So I'll just read one. This last italics thing is taken from Sequoia's letter, and that letter is that thought process is as recent as May 2022, the same month when we are taking this session. So the thought, and it's a detailed report, you can read that report available online, but it is that cheap capital has dried up and the cost of capital is becoming expensive. The macroeconomic situation is becoming less certain, leading to the investors deprioritizing and paying up less for growth. So typically, if you look into the fundraising ecosystem, then fundraising ecosystem essentially is dependent on growth. So if you take any company to start to a venture capital fund, okay. Now, the thought process that a venture capital fund is having is that, we would not be willing to fund every company, but we are willing to fund companies which are scalable and which have potential for high growth, which can take a market leadership position. Now, again, the focus was never on profitability. The focus was on growth. And that is why I say that if we go back in 2008, in 2018, the same situation was there. Ultimately, you look into that, probably in India, the venture capital industries, it started about 2016 or 2006 or so. So I started my career in 2005, and I have seen this ecosystem evolving, whether in terms of valuation or in terms of regulations or in terms of the core funding transactions. So the ecosystem has evolved, and we have seen, even in 2008, there were talks of GMVs, correct? Gross merchandising value. How much can you sell? So the person who used to sell the highest, that particular company got the highest valuation. So GMV was even one level above revenue, correct? Because GMV is not accounted in your books of accounts. You get a particular fraction of, very small fraction of revenues, depending upon what is the kind of product. It can range from 1 to 10%. That is what comes. So the basic idea is that, the people and the companies only focusing on growth, it is a challenging time for them. And a lot of companies, I would show you some trends also, that what is the effect of that. So this is very recent data. Again, in May, about 6,000 employees have got fired. You can see the names and leading companies, unicorn companies, Unacademy is there. Lido is one company which has recently got closed down in EdTech domain, because EdTech was a very, EdTech was the largest beneficiary, I would say, of this COVID time. But what has happened that, now students are coming back to school, things are resuming. So everything which was dependent on consumer and actually dependent on closing of economy is getting affected. EdTech is one large company, but it's not that only EdTech is there. Cars 24 is there, I mean, and these are the names, and I could find some rationales also, right? So some people are saying that they are cutting their costs. Some people are saying that they are automating. Some people are saying that, their funding is getting delayed, so they want to extend their period of funding. Some people are changing the business model. Some people are saying there are financial constraints. Surprisingly, there have been instances when the people have been asked to come back to work and resignations have been seen, and significant resignations. Again, restructuring is one reason that yes, time is not apt, and at this time we need to scale down, cost cutting, and again, so and so. So if you look into all of these things, I mean, the idea is to tell you that what is happening at this point of time. Because sometimes we just say that our company is good, and a similar company has raised a particular valuation in like 1 year back. So you have to be clear that timing of valuation, when you take the deal to the market, it is very important. And it's not that all the deals are bad or all the sectors are bad. We need to understand the trends which are going. Again, like SoftBank is one investor we all know. Now, SoftBank has recently reported a loss of $26 billion. There is a particular fund, and what is communicated by their CEO is that they are investing only 25 to 50% of what they did last year. So very clear. I mean, technology startups are in a bit of despair, I would say. And in India also, when we used to do valuations of e-commerce companies, I mean, we could never find the similar companies in the Indian space. So what we used to do, we go to the, NASDAQ markets and Yahoo Finance databases, and we used to find that, what is the valuation of Alibaba and what are the similar comparable companies which are there, because those are the global companies. But then recently we have seen the tech companies, e-commerce companies. Yeah, can you please mute? Yeah. So we have seen the fintech companies getting listed on the Indian stock exchanges. Nykaa, Zomato, and Paytm are three names written here. And Nykaa is 67% down. Zomato is 43% down. and Paytm is 73% down. So the point that I'm trying to make here is that all is not good at the moment, specifically with respect to the technology companies. And the only hope that I want to keep here is that this may not be a permanent situation. Trends come and trends go. So we need to understand and we have to look at from a longer term perspective, but the companies need to survive this period. Because if you have a lot of expenditure, you have a lot of clutter around you, and you are not able to meet that fund requirement. You have to pay salaries, you have to do marketing, correct? So the minimum fund requirement is there, and maybe it will take an year probably for the things to settle. But the silver line that we see here is that the enterprise startups, so B2B startups, which are actually not burning a lot of cash, in fact, they are profitable and maybe highly profitable, they are in a better position today than the startups which were chasing only growth. Now, this trend, if you look into, it's just about a 5 months trend, and it is not an Indian trend. So India comparatively is better off, because the simple reason is that in India, there are not many technology companies. So I gave you an example of these 3 companies, and all of these 3 companies, which are technology companies in India, they are significantly down, correct? But if we look into the US market, then there are larger companies. So what this chart is telling us that, there is a comparison of NASDAQ 100 versus, technology sector. So the technology sector, if you look into Morgan Stanley unprofitable tech index. So the companies which are not making profits and the other 100 companies. So if NASDAQ is down about 28%, and this data is still 1st of May, recent numbers may be a little different, but just to give you an idea, this chart is also taken from the Sequoia report, because the idea is to tell that if you are not profitable, then you are getting penalized today. So the days are over when the money was free, when the interest rate was 0 in global economies, when the inflation was not there, everything is coming back. So you need to be prepared for it. And that is where, all the thoughts of M&A comes. So I'm moving to the second trend now. I'm connecting the startup system with M&A.
Chander, I have one doubt. Can I ask?
Yeah, please.
Okay. Yeah, see, when you say that this has to be, trend has to be considered in valuation, do you mean that we have to add premium or discount depending on the favorable and unfavorable conditions in the economy?
So see, when you say valuation, first of all, we have to understand that what is the purpose of valuation. Correct. So what kind of valuation you are trying to assess it?
Valuing the company.
Yes. What is the purpose for that?
Raising equity.
Raising equity. So when you are raising equity, then the first point here is you have to understand whether it is the right time to raise equity or not. Because we can do a paper valuation, no? Paper valuation using the methodologies of whatever scorecard model or DCF model or comparable multiples, right? But there is a market trend also. So when we are doing some valuation, we have to understand that if you do a comparable valuation, then probably the past comparables may not be relevant to be considered at this point of time. Because what happened in the past may not happen now, at least not at this point of time. See, valuation is always at a point of time. You have to understand that.
Yes.
Right. So we have to look into the fundamental valuation, because fundamental valuations, that is the cash flow generating abilities of a company, should be given more emphasis rather than the comparable companies. Correct? Because there are broadly 2 methodologies for valuing these tech companies or startup companies. One is the cash flow based approach, and second is the multiple based approach. And then we may put some flavor of qualitative factors, scorecards, and non-financial. But essentially, the simple thought that I want you to take home is that if a company is not able to generate net cash flows, then it is not valuable. That is a simple, see, we used to say that top line, essentially, see, there are 3 things. One is top line, one is bottom line, and one is cash flows. Correct. So cash flows is the ultimate value driver. If you even look into from a finance perspective, then what has happened, even without cash flows, a lot of companies got a lot of valuation. But now that situation is not going to happen at this point of time. So that is why I said that preference will go to the profitable companies. Preference will go to the companies which are doing something unique and burning less cash. So cash flows would be the right value driver, in my view, in these kind of situations, and multiples are best of all.
But how do we put it across to the client?
You prepare a projections and do a DCF for that.
Right. So in projections, when we are preparing projections, rather in one of the companies, when the multiple approach was used, market approach was used. So in market approach, they did not get good value. So they went ahead with the projections. Now, of course, projections, like what is the reason for going for projections?
No, see what happens. You have to ultimately see all the methods. Correct.
Yes.
Now, in this particular case, wherein the market is constrained and the technology companies are not getting funding. So I am just sharing my perspective in this particular scenario. The methodologies will change because as a valuer, it is our responsibility to choose the methodology.
Right.
The client cannot tell us the methodology. Even the international valuation standards put this onus on the valuer to decide which method. So my view is that, see, very simple, that if something is getting, suppose your business is continuing to grow, you ask for a month-on-month number from the client, you will get to know whether the company is growing, whether the company is profitable or not. So the projection will also happen on the same trend. Projection will not happen that I am not growing today and tomorrow I will start growing. Correct?
Okay.
So I'm just saying that if you consider the present situation, whether that presentation is positive or negative, and you extrapolate that situation, that is a better version of valuation rather, because company can get some future cash flows. No, we are not saying that company cannot get any cash flow. But whether earlier the companies used to show, like if you try to value a startup, they show 600%, 500% growth year on year. Now, how can you expect that kind of situation in present situation? Right? So it is a very fact specific, client specific, situation specific discussion. But what I'm trying to convey is that cash flows, if the cash flows are made conservatively and reliably, so if you can accept that, yes, this projection is something which the client can actually achieve, and I have seen the recent trends, and this is doable, then that kind of cash flows should be used. You have to take a conservative number. You cannot take an aggressive.
Okay.
Correct. And see, price and valuation are also different. You can do some valuation, but the market may not give its price for that. Right. So what the investor offers may not be a valuation. So there are some deals wherein investors have their thought process that we will give only this much amount, and they have their own workings. So that is why we say that ultimately for the deal to happen, it happens at the equilibrium of the demand and supply. As valuers, we are trying to assess the most economically viable option. But whether your assumptions, the assumptions which the client is making, whether the buyer or the investor is buying those assumptions, that is very important. Once the financial model is agreed and accepted by the investors, then I think valuation difference should not come significant. But the bigger problem is that investors generally or buyers have a totally different business plan. And if the business plan is different, then the valuation will also be different. So for startups, what is more important is that sitting with them and devising a viable business plan. That is why when startups come to us for valuation, we generally don't do only valuations. We ask them to give us a mandate of review and advisory on the financial model also. Because if you just do the valuation basis the projections given, the valuation of a startup can be humongous.
Okay.
And that is a challenge which we face in daily life. So model needs to be sanitized. Once it is sanitized, I think some questions which you are asking, they can get resolved.
Okay, okay, got it.
Yeah.
Thank you.
But again, I mean, it is something which with experience you need to take your decisions. Yeah.
Right, right.
So I'm going to the M&A trend slide. Now, if you look into this M&A trend slide, then it is since 2004 till the 5 months of 2022. Now, if you look into this, then 2018 was an year, which I was mentioning also. And 2018 was an year wherein there was the maximum value of deal activity. And the reason was again that, it was a kind of situation wherein there was stress, the funding had dried up, and so the deal activity had grown. In terms of number of deals, so the blue line is the number of deals, the maximum number of deals we have seen in 2021. And in terms of 2022, if you look into, then the activity is low. In terms of number, actually, the activity is equivalent to 2021. So this is signifying that the M&A deals are taking place. I mean, just the same data that I have shown in the graph. This is the same data spread across the last, from 18, I have compared till 2022. And in 18, there were 714 deals, 19, 703, 25, 18, 21. So deal activity is growing. Okay. And even in the 5 months, there are already 450 deals. So in fact, the deal activity of M&A is rather growing, and not in terms of value, because for value, there is stress. Okay. So you are not willing to pay that much, which you were willing to pay earlier. Obviously, it's a pricing, like I said. And the maximum deals, if you look into, I have sorted it in value order. So healthcare and life science, IT and IT-enabled services. And by the way, whatever are these technology companies, all of these companies get clubbed into IT-enabled. So they get clubbed into EdTech, health tech, rural tech, agri-tech, all the traditional businesses plus tech is IT and ITES. Then telecom deal is coming because of actually Vodafone deal. So which, so this also includes the strategic investments. It is not only pure play acquisitions, it also includes strategic. So the government of India has taken some stake in Vodafone. So that is this telecom deal about. And BFSI deals, manufacturing, energy. But largely, if you look into, I mean, if we go back in 2021, then the maximum sector was IT, ITES. So, which was about $32,000 million. So, largest of deals generally happen in IT enabled. But if you look into the trend, correct, then even IT enabled are the trend, the current number is not showing that much. So, the value has decreased across the deal, across the life cycle, but the number of transactions are increasing, because the simple thought process is that the companies which will be unable to raise fund, they will become strong M&A candidates. So what is happening? That the world is changed, like we discussed. There is uncertainty, there is geopolitical instability, there are shifting consumer preference, there is accelerating digitization. So remember this, that those companies which have adopted digitization, see, work from home and digitization will not go away. Right? The large companies will always prefer work from home. Maybe the senior people can come, junior may not come, but the digitization, any company which has gone digital is something which will always be a value added situation. COVID is a question mark. Whether COVID has gone, not gone, who knows? It comes again. So uncertainty again, and increasing cost of capital. So there is a need for agility and adaptability to remain relevant. And two main acquirers which we are able to see, because investors would not like to invest in these kind of situations. But what about the companies which are into leading domains, which want to do those companies which do not have some core competencies, some capacities, which have not been able to go digital, they are working the traditional way. They would like to acquire companies because they are cash rich. So what has happened in the last 2 years, 3 years, I would say, a cash has been conserved. When COVID came, a lot of costs got reduced, correct? So when the cash has got conserved, then they have the capacity to acquire. Now, just to give you some numbers, as of May 22, the Indian unicorns only have acquired 326 startups. Flipkart acquired and undertaken 17 M&A deals. Byju's, every day you will listen some kind of news. They have acquired 16 deals. Zomato, Quicker, Mensa, CureFit, all of these companies are acquiring. So why I'm giving you data is that what I'm telling you, or wherever I'm sharing my thoughts with you, I'm trying to give data also so that you can connect it with those specific aspects. Just a second. Yeah. Now, recently I could find some study recently done by EY. And now the point is, because we have all discussed that the focus is on profit margins. So what are companies doing to increase the profit margin? You need to look into that. This session is not into an Excel thought process. It's a thought process session, and it's not an Excel session wherein, we need to understand that what will happen and what are the ways to do it. So that is once the basic foundation is ready, then any kind of valuation you are doing, you will assess the model on these terms. And once you do a right assessment, then most likely your valuation should also match to the expectations of the buyers or sellers. So in terms of profit margin, 27% of the people, it was a poll which was done by EY very recently, again in May 22. And 27% said that we will use technology and automation. So wherever there is high labor cost, we want to improve scalability, we will use tech. Second, we want to use customer interactions through digital platforms. Correct? It saves your cost, and digital is again one thing. Third, we will reduce complexity of business. There are so many businesses. If there are some surplus assets, we will dispose. There are some underperforming assets we will not use, and we will divest the underperformance products also. So a company which had a lot of funding had opened at 20 products. Now all 20 products are not scaling up. Some of them need more capital. So they have to decide which product they want to continue and which product they want to dispose of. They will reduce certain overhead. They will improve the supply chain efficiencies, because supply chain got affected at this period of time. They will introduce new pricing mechanisms. So if you look, and last is shifting operation to lower cost. So these are the actual trends, actual poll results of what are the ways wherein you have to improve profit margin. But my question is that if you are unable to do on your own, then what will you do? And the answer to that is that you have to do an acquisition. You have to invest in a company which is doing these kind of things because you want to do it, but you don't know how to do it. And that is why the second thought process comes is that post-pandemic, the M&A activity, if you look into, so M&A activity is connected with that you will be doing acquisition for operation. So if you have clients and clients are facing some kind of problems, then you have to look into that whether there are other companies which are trying to do these kind of things and which are already doing. So a company which is already doing does not know how to scale it up. A company which is a large company has money, but has not built capacities. So please understand, a large company does not mean that all the capacities are there. There could be operational capacities. ESG is something, economically sensitive we are becoming. Then can you do some smaller acquisitions to increase the market share? Can you acquire the talent, capacities, innovative startups? Can you look into geographical expansion? Can you look into newer business model, newer customer base? Can you look into some more sectors? So the idea here is that, instead of we thinking what is going to happen, there is a lot of data which is available around us, and we have to actually look at it that whether we are clients, or whether, the clients with whom we are working with, we can help them in this process and we can connect them, because M&A is increasing. And when you say deal valuation, see, deal valuation is very different from our regulatory valuation. See, in regulatory valuation, the clients have decided and they tell us, boss, 22.4 rupees we want, and give us a registered value certificate. But in deal valuation, if you have to value, there will be debate on every assumption, every aspect of it. So we have to be knowing the perspective and situation when we are doing that kind of valuation. So any questions till now? I mean, I'll be going, the session is spread across so I have given the trends of startup, I have given the trends of M&A, and now I'll be going into the M&A process, and then we will softly touch the valuation aspects of merger. So any question in the trend you can ask, and then we can move forward.
See, I had raised one small issue. See, as of today, there are certain incentives for startups and either income tax incentives or subsidies or whatever it is. So maybe the stage will come when the sunset period, what they call it, no? So such period comes, or when the incentives withdrawn, then more and more, because these smaller companies can't sustain at that stage, no? Then the mergers may become more. Am I correct?
Yes, you are right. But I mean, if you look into the tax incentives, then tax incentives are relatively newer for startups particularly. So I mean, and see, one is that you get a DPIIT registered startup. Second is you get the tax exemptions. And if you look into the database, that not many companies have got tax exemptions actually. So you will be seeing the DPIIT registered startup, which is a significant number. But still, as of now, to the best of my knowledge, there are not many companies who have actually got the tax exemptions. So in terms of the tax perspective, because I mean, there's a 10-year window for the startups, and out of 10-year window, they can claim the tax exemption in any 3 years. So even if they are not surviving or not growing at this point of time, in future, if they earn profits, they can claim that window. But yes, there has to be some opportunity and some trigger point. Even markets, capital markets work like this, right? I'll give you an example. When LIC issue was about to come, then we were just debating that, LIC is a large issue. So what would be the impact of LIC issue on the markets? And we were apprehensive that, it will suck a lot of liquidity from the market. But what government did was actually that, government had scaled down the IPO issue. I mean, earlier it was talking of a large valuation. It toned down the valuation. But still, you look into that, the day LIC issue came, I think when the LIC issue came on the last day, the RBI governors had announced the increase in the interest rates, correct? Citing inflation. And it was a sudden meeting. So, there was a trigger that yes, the RBI has intervened, interest rates are going up, and you just look into, I think, the 1st of May, and you look into today, there is so much volatility, so much uncertainty, and it's ups and downs and ups and downs. So there will be triggers. One of the thought is what you are saying. Some other thoughts are what I just shared. But yes, whenever there is trigger, it will undertake an M&A, because the moment one company becomes unviable for a particular promoter, the same company can become a viable company for the industry leader or some other promoter. But yes, probably the valuation is very important. It will play a very important role there, basis which the deal will culminate.
Chander, this is Nataraj here. So what I think is that the trigger for any merger and acquisition, I mean, there are various aspects. One is not only whether the company is performing bad or it's going through a cash crunch or whatever, but however, there is a possibility that even if the company has a fantastic idea and technology, and the other company which is actually in a better position, who wants to acquire the market, who wants to do a monopoly will get into a merger acquisition scenario. That's what we have seen in the area of Byju's acquisitions. I mean, Byju acquiring all smaller companies. So do you see there is a consolidation happening because of positive vibes, or it is because of some companies not performing? So or it is a mixed kind of scenario?
So see, right now consolidation is definitely happening. And see, M&A, like I had shown you a trend, M&A was there in 2004 also, and M&A is there in 2022 also, correct? There are different reasons why M&A happens. And one of the simplest reason is that when you want to grow faster, you tend to resort to M&A, because inorganic activity can, if you have money and you are not using that money, you are becoming inefficient. Correct. Any company, if you keep cash on your balance sheet and you do not use it, we have seen a lot of companies which did not use it, and the result was that those companies failed. Or later on, the companies either did acquisition, or they did some buybacks, or they paid out some dividends, higher dividend, because ultimately the idea is to do things which maximize your cash flows and which maximize your productivity. So at this point of time, when we are discussing, the consolidation is happening, and there is a situation wherein, obviously the company who is acquiring wants to add some capability and wants to grow. But why the other companies are selling? It's basically because of the stress in the market at this point of time. Correct. So whenever I will acquire as a buyer, if I don't see any capacity building, if I don't see that this company is leading to my growth, it has to solve some problem. And we discuss some problems. What all? Supply chain problem, capacity problem, digitization problem. There has to be certain problem. I am a loss-making company, happy to acquire profit-making companies. Why? Because, we have seen the fate of Indian technology companies. So why not at least create some kind of profits and improve my balance sheet before I want to go public? Even an academy for that stake. Happy to look at the profitable companies. So yes, people have understood that when you are in a private space, you are closely guarded by the investors. But the moment you jump in the public space, you are open to the public, and the public is not having that much of patience. Public is not here for 20 years with you. Public has invested money. They want to get returns, and they have understood that technology companies are not giving that returns because they want to save cash. So right now there is a stress, as I wanted to say, and that has an impact on the valuation. But yes, irrespective of the stress, M&As used to happen before, M&As will continue to happen. Only why it is happening and how much impact. In good times, people pay crazy valuations for M&A. In bad times, they even fail to pay the actual valuation of the company. So timing is very critical in deals. And a lot of times we have seen that the promoters want this company, but they leave it just for the sake of valuations.
Chander, one more thing. See, this mergers and acquisition, the main motto is to increase supply chain or the synergies. But whereas in India, the more acquisitions is happening to eliminate the competition. It is not mere to synergies to get. To eliminate competition, only more acquisitions are happening. Even if you see that most acquisitions also, a lot of failed also is there. Like HP acquired Emphasis. Even they posted a lot of losses afterwards. Even IBM acquired a lot of companies. Even the one acquisition which we have seen is Facebook acquired WhatsApp. Yes, it was a great acquisition. But in other cases, it was a lot of failures over there.
Yes, Venkat, I agree with you. But again, see, it depends upon the timing, right? So if you look into the M&A theory or M&A strategies, then one of the strategies is to kill competition, correct? And see why investors keep on putting crazy numbers and crazy valuations to the startups, because ultimately the idea is that, one of them will become leader. Correct. And for that company to become leader, you have to clear the path. But right now, that is not happening at this point of time. And the reason is that is a good strategy for a growing market. But in this market, if there are smaller companies and they don't get funding, they will automatically get closed. So that is what we are seeing, that today all the startups are giving a message and all the investors are giving a message to conserve cash, to save cash, keep the kitty for 24 months. Now, how to keep the kitty? If you have already expenses and overhead, so you have to cut the expenses. So strategies change depending upon the time we are operating in.
Okay.
Chander, very practical question. Suppose if the startup is coming for a valuation, should we educate them on this? That the times are stressed, markets are down, you might not get good valuation, given
Yes,
that
why
validity
not?
of
It's our responsibility. He may not give us the assignment also.
right. तो आती लक्ष्मी को कौन मना करता है?
नहीं, लक्ष्मी ले लो पहले. और लक्ष्मी लेके, see, we have done a valuation of an edtech company, and we gave them some 10x of revenue. Okay. And the client was not satisfied. Now, what should I do? So client can ask for a moon, but then you have to stick to your experience that this is something which I can do. And sometimes, that is why I asked a question, that what is the purpose of valuation? If you say that you are ready, investor is ready, buyer is ready, okay, everything is done, you have to do a compliance valuation, do it, not a problem. But when a client wants to take your report to the market and show that, see, first of all, it's a very misnomer. It doesn't happen that you take a valuation report and investor will do the funding. It never happens. So I don't know who tells and who guides the companies that you take a high valuation and then investor will fund. Investors are not fools, no.
Right.
They understand whatever we are discussing, they are more educated and more knowledgeable people than us. We still have our capacity limitations. We are 3, 4, 5 people, 10 people. They are, they are large institutions. So our role, whenever I have done a startup valuation, I have always tried to, first of all, go into the financial model and understand and discuss and debate with the promoter that, yes, whether this is doable or not. So the moment you debate and go deep dive into a financial model, there will be a lot of assumptions. And if you look into, see, Ind AS 113, what is Ind AS 113? Fair value standard. Now, what fair value standard says, that you have to follow a hierarchy and you have to start from observable input and then you have to come at less observable input, level 1, 2, 3. So what do you mean by observable input? That I know that this is happening, I am able to look at it, so I can do valuation on that basis. Market, I can see the market. The company's financials, I can see. Company's orders, I can see. So if you extrapolate that, that's an observable value. But if the client says that, no, I will grow 600, 500, 400, now how can that be an observable? So that is why the fair value standard also guides us that we have to look at and give more emphasis on observable and less emphasis on unobservable. So there can be debate, there can be difference, but that is the real experience of a valuer and the real advice of a valuer. Some clients will agree to it, some clients will not agree to it. But the reason, my client did not get the value funding at this point of time. And the number that actually at that point of time we had given 10x, today we will not give even 5x.
Okay.
So times have changed. We were not aware in March that this kind of severe emphasis can come. So valuation date is important. Whatever is happening on valuation date, you cannot ignore that. That is why, now some clients will say, nahi, aap kar do valuation. So you can look into, whether you are comfortable or not, but generally it doesn't help.
Okay.
You give a lot of caveats in the report and write that, we have
Right.
not reviewed and this and that.
Mhm.
If that, I mean, that will not help the client, but still if that makes him happy, then you can give it.
Okay.
See, even if you give the valuation, okay, even in one of our case, like 7 crores we have given valuation. At the end, that US company wants to buy at 4.5 crores. Then the promoter is no choice. Okay, then he sold it for 4.5 crores. Even valuation is 7 crores.
Right.
In these cases, okay, the demand and supply only is playing more role than valuation or real. Okay,
Yes,
whatever.
yes. In actual real life, demand and supply is actually important. Paper valuations don't support, but yes, I mean, if you have prepared a proper financial model and you are confident of the financial model, then we can have a debate that why a valuation should not be there. And if somebody is not paying for it, does not mean that it is not valuable. He does not have money, that's his problem, not my problem. But the role of a valuer is to see that on the valuation date, considering the scenario, whether we have factored in all the aspects or not. That is why the companies whose valuation are getting severely affected are the companies which are dependent on external factors. Like if a company was obtaining something from Ukraine, then that company has got affected. If a company wanted month-on-month funds because it was burning cash flows, then it has got affected. If a company which had supply chain problems, that has got affected. So we have to understand. But if my company is not having those problems, then
Yes.
Then it's okay. Why should I adjust my value? In fact, I will become stronger in that case, because I know that there will be some companies who would like to buy me out. So there will be some companies which will become stronger, and there will be some companies which will go down. So, I mean, that is how it happens. Should we move forward now?
To understand the financial model, we need to have fair understanding on the industry in which the company is operating, correct? No?
Correct. You have to look into the past performance of the company, and you have to look into the industry, and you have to look into some statements and how the industry leaders are performing. So all these things need to be compared.
Okay.
Yeah. So now let's come to M&A roadmap. So typically, why do we do M&A? A lot of questions came, but one perspective is simplification of corporate structure. Second is value unlocking through corporate structure. Can you do a merger? Can you do a demerger? Can you do a slump sale? Can you do a hive off? Because by structure are there. Should we create a holding company? Are there subsidiaries company into different lines? Should we merge the different companies which are into same business line? So corporate structure has a very big impact on the valuation. Tax efficiency, again, some companies might be having losses, some companies might be having profit. Should you consolidate that? What kind of value creation can be done? I mentioned consolidation of same business, segregation of different businesses, segregation of surplus assets. Sometimes, there are companies and, which are operating on good piece and old piece of land. Now, if you look into that old piece of land, the land is highly profitable right now, but the company is still running the old business on that land. So can you segregate that land? The land will become a surplus asset. The company can take another land. It can buy it or it can lease out, and it can operate the same business, correct? But the incremental value of the land will become surplus, and that can be a value creation for the company. Can you segregate the promoters and company assets? I mean, right now, when the company is closed, sometimes, promoters use their own land. There is not much segregation, but when you want to go bigger, when you want to take money of an outside person, all these questions become very relevant. And the last point is what we just discussed, that what are the market trends, whether my valuation is getting affected. So what we are seeing is that, a lot of M&A is going to happen, and M&A has two roles. One is that if you are advisors, as professionals, we can do deal making. We can try to connect a buyer with a seller, and we can do all that advisory. Second is that when the transaction takes place, then at that point of time, all of these things will happen, and ultimately you will have to do some kind of merger, some kind of restructuring, some kind of shareholding transfer, some kind of slump sale. So that is where a professional role comes. And the idea was to share in this presentation that yes, this is the trend, this is the opportunity, and this is what as professionals we can do. So specifically, I mean, in terms of restructuring mode, what can be done is that yes, there could be some court approved restructurings, NCLT routes, mergers and demergers. Business asset transfers can be undertaken, slump sales can be undertaken, voluntary winding up of some companies can take place, shareholding reorganization. Obviously, there could be some further issue of shares, there could be some transfer of shares. And if there are some companies in the growth stage, I don't think that this IPO point is relevant for this point of time. But yes, the moment there is a momentum which is back in the market, then again, IPO direct listing can take place. So now what are the applicable laws on M&A? If there is any transaction, the one aspect which I wanted to cover was also the regulatory aspects. Because what happens as a professional, if you want to do all of these things, then you have to be aware of the market trends. You have to be aware of that in what ways the value can be unlocked. You have to be regulatory. You have to be aware of the regulatory provisions, because a merger there are a lot beyond valuations. There are a lot of regulations. So to do it end to end, we must be aware of those. I thought I should just touch upon them, that starting from company law, income tax law, competition law, FEMA, stamp duty, GST, accounting standards, SEBI laws, sectoral laws, all of these are important. Obviously, SEBI will come into play when there is a listed company. FEMA will come into play when there is a foreign shareholder. But a company law will attract in all case, income tax will attract in all case, stamp duty will attract in all case, accounting and GST will attract in all case. Competition law again will trigger when the transaction which you are doing is beyond a particular threshold at a group level or at a company level, and then, so all these laws are something which we have to look into before we advise. Now, what can be the role of professionals in the M&A deal journey? So I just broke this into two parts. One is the financial advisory and second is the tax, legal and regulatory. So if we start from down, then a few questions were that what should we do? Okay. So this slide is actually answering those kind of questions. That first of all, we should start with this business industry research and recent deal. This is something where we should start. That yes, first of all, we should see that this company, because what happens in case of deals, you cannot take all the deal mandates. You have to look into that whether deal is, you can do all valuation, but you cannot take all the deal mandates, because the deal mandates work on a success base and the valuation is on a professional basis. So you have to be selective in the deal mandates. First of all, you need to understand, but even for valuation, you need to understand the business industry. Assessment of recent deals is important. How has been the trend and what has been the trend for the recent deals? You have to look into the promoter's background. Very important. I mean, a promoter who has built up a startup in the past and sold it to another company successfully will get instant funding, or the probability of funding increases because it has already, that person has already proved the caliber. Okay. So the investors are ultimately banking upon the promoters, by and large, the founders. So that is why the promoter background is very important for any startup. Management team is important, whether there is capital commitment, traction, everything is important. As an advisory, what we can do a pitch book review, and we can do a pitch book advisory. We can do business valuation. We can do financial modeling. So financial modeling is the first step, I would say. Valuation is the second step, and pitch buyer can take to a investor. So these 3 collective steps we call as preparatory steps. And then once the preparation is done, then the work starts at a deal level. So that can happen at phase 2 in terms of connecting with the appropriate buyers and sellers, basis your relationships, or basis maybe you can just check on, use LinkedIn or whatever sources. Then once the buyer and sellers show interest, there is a prima facie interest, you need to structure the deal. It takes a lot of time because the demands are very different. A buyer obviously wants to pay the less, and the seller wants the maximum. So you need to structure the deal, you need to negotiate the deal, and then once a negotiation is done, then you need to jump on the advisory, because obviously there will be tax element, there will be stamp duty issues, and there will be due diligence, legal documentation, approvals, whatever. Okay. And so this thought process, if you just look into this slide is made actually for professionals like us. And the idea is that this is a complete spectrum of services that we can give. We can choose to give, when we say valuation, it is one part of the total deal. Whether we want to stick to valuation or proper documentation or proper deal making, or even the regulatory part. So we as a firm, we are doing these kind of situations on an end-to-end basis. And what we have learned is, basis our experience, that, generally deals, when they don't happen, because there are a lot of consultants also in this play. So if you can just, build on capacities on working into this end-to-end, probably we can be value centers for our client, and we can add a lot of value. We obviously, wherever we do not have enough bandwidth, we can, connect through our fellow professionals, and we can take it forward. Any thoughts on this slide before I move forward? If anybody wants to understand any particular thing on this slide.
Chander, can you go back to the previous slide?
This one?
No, next slide.
Oh, sorry. Yeah.
Yeah. No, not this one. Okay, the trends. This one. Okay, here maybe, okay, the restructuring modes. Maybe you can add IBC also. Today the trend is, okay, a lot of acquisitions, mergers is happening through IBC also. Like, okay, like you will get big companies. Okay, like running companies will get through IBC.
I get it. You are right.
Yeah.
Actually, this M&A, which is written NCLT route, besides NCLT, there could be one IBC perspective also. You are right.
Yes. And most of the mergers is happening nowadays, okay, to reduce the compliances, okay, because even previously, like a lot of promoters used to start a lot of companies. Now, when we are seeing any mergers, okay, the main purpose is, the promoter purpose is like to reduce compliances.
Yes, so like I said, out of these things, you have to look into reducing compliance. Is, yes, you're right that it is required, but the only value addition, that I would place that merger in the lowest of the category, because if you look into compliances, there are not enough compliance. How much compliances you will stop? Even if you do a merger, it will take about 4 or 5 lakh rupees for an end-to-end process. So yes, but you are right. But what we have seen is that is not on a value addition side. So if there is some other important aspect to it, okay. So what are the kind of benefits? When you say compliance, see if there is something fishy in that company. Sometimes a company might be facing some litigation, or there could be some other aspect. So that is something which, you can do it. But if there is a clean company and just for a statutory audit and all, may not be very prudent advice to do.
Yeah, correct. Unless they have some process, okay, to follow and all those compliances, okay. Sometimes if they forget, then okay, the directors will be disqualified and the company will go to strike off. Okay, to come. Yes, as you said, it is
so what you can do there is actually the better version is to do if there are no assets and liabilities, the better option is to do voluntary and or maybe strike off the companies, sell off
Correct.
all the assets and get it strike off.
Yeah.
That could be a cheaper option.
Yes, yes. No, that is a cheaper option, but when they have some few assets, they can't close it, then they are opting these matches.
Correct. Obviously, there are assets, then you have to do it. Yeah. Then
What is pitch book review and advisory?
so pitch book is an investment. It is an investment presentation, a pitch deck that when you prepare, then you have to present it. So you have to pitch it.
Okay, pitch deck.
So some companies come up with their own investment documents, but as a professional, we can guide them that, you should refine your pitch. I mean, typically when you present your pitch, then you get 10 odd minutes, 10, 15 minutes. So maybe, I mean, your pitch should be small and precise. And at the same time, it should address all the important aspects that an investor would like to understand.
Okay.
So we can actually add value in telling them that this is relevant and this is not relevant at this point of time.
We are not kind of exposed to these pitch book reviews. Is there a session that you can actually take for us and demonstrate as to how this pitch book review happens and what are the aspects? You broadly told us, yeah, it has to be precise, it has to be focused, and it has to be covered in 10 minutes. So is there something that you can throw more light or
So
help us?
just what we can do is that, if you go into any investment, like there is suppose there is Indian Angel Network, okay, IAN. So this IAN invests in a lot of startups. Now, if you go to IAN website, then there is a process what you have to follow. So they have also given a checklist that we want to understand these 8 points. So what we did in our experience is that, we collated a lot of investors' expectations and then we summarized that, and pitch book is not standard. Pitch book will vary because there is no hard and fast format, but a few things which probably an investor wants to understand is a brief about the opportunity, about your business. What is the kind of team you are having right now? What is the traction you have shown? So one thing is that I will do this, but have you done something? As a person, have you done something in the past? If suppose you are a finance person, is there a co-founder? Is there a tech founder? Because in all the startups, there is generally a tech which is involved. So is there a tech founder? Is there a finance person? And is there maybe a CEO type of person, right? So whether there are people for all the activities, what is the kind of opportunity? What is the kind of size? What is the kind of differentiation? And probably what could be the kind of execution? Because sometimes we have seen a lot of decks, and what happens in a lot of decks is that, we talk about the India story, that India is doing good and, there is a lot of. Can you please mute, Mr. Ravindra? Yeah. So, so there's a lot of thought process behind India, but probably what the investor wants is not about India, but about the company, the promoters, and how they will make it happen. So essentially, we put one slide for these 7-8 things, and we try to conclude the opportunity in about 8 to 10 slides, and different people will have different ways. The idea is to keep it, like I said, precise and all. Just for your reference, I had given you, go to IAN website and download that document. So you can, you can look into these 8 things are there. An investor actually, to see the kind of investments which used to happen 15 years back and the kind of investments which are happening today are very different. Because at that time, India was essentially taking the best practices of global markets. But right now, if you look into startups, then where should you do a startup today? Correct. So because there are already a lot of startups operating in different segments. So essentially, it is not about uniqueness today. It is about the differentiation could be your execution strategy. So everybody is doing, but can you execute it differently? Do you have a better bandwidth to do it? All those aspects are important.
Can you please repeat the name of the website?
Chander,
IAN.
just one question, Chander, that now since if we provide all this kind of services, entire M&A boutique services, the valuation can be from our associate network partners, or it has to be totally different in terms of independence. Is that make a difference?
See, if you are not signing a report and the idea is to see if you are playing as a role of an advisor, then why don't you should do the valuation yourself? Unless and until it is for a regulation purpose, then it has to be independent, in my view.
Yeah, thank you.
Yeah, so I'm moving forward now. Now, a few issues that typically when we do, and I'm restricting this discussion on NCLT approved scheme of arrangements. Okay, so two large issues which we observe in NCLT approved scheme of arrangement, and actually out of two, in fact, the first one is the most important, is the stamp duty cost. Because the moment you do a scheme of arrangement, you have to issue the consideration and there will be transfer of assets. So there will be stamp duty on the movable and immovable properties. The stamp duty is not exempted in the court approved scheme of arrangements, NCLT approved schemes. But yes, it is a state subject and it depends upon where your asset is situated, immovable property, and what is your ROC, what is where your company is registered, because there will be tax, there will be the stamp duty valuation on the issue of consideration basis the stamp basis the ROC where you are situated, and second will be based upon the location of your immovable property. So stamp duty is one issue which we need to address before recommendation. Capital gains, otherwise, if you follow the requirements which are there in the scheme of like section 47 is there, and section 47 exempts the capital gains. So that is if you have to just qualify the definition of mergers and demergers. So income tax is generally saved in that case. When you do valuations, again, whether it's for minority shareholders could have some concern, fairness opinion is required. So a relative valuation is to be obtained, which I'll just cover in the next perspective, that yes, that it's not an absolute valuation. There are two companies are getting merged. You have to look at it on a relative basis. What are the kind of timelines and processes? Typically, it takes about 9 months time for a merger and demerger process through an NCLT. Again, registered office, I mentioned, important. And then there are, approvals, shareholders, board, creditors approval, regulatory approvals. Regulatory approvals, more important in case of, listed companies, because when there are listed companies, you need to take even SEBI approvals, which it takes through stock exchanges. So you have to file the scheme through stock exchanges and they have to give approvals before you file the scheme to NCLT. Then there are shareholders approvals, and then there are NCLT approvals, and then, there are some roles and involvement of, regional directors and registrar of companies. There has to be notice to the departments, income tax department, some statutory departments. So these all things are important. I just wanted to touch upon. And typically, this is the way it flows, that we first do a valuation and we prepare a draft scheme. It goes to the board of the companies. There has to be stock exchange and SEBI approvals. We file with NCLT. There are shareholder, lenders, creditor approval. There are ROC, OL, income tax department, sectoral regulator approval, NCLT approval. Post-merger, purchase price allocation and integration. So when there is valuation, initially the first step is valuation, and the last step I would say is also valuation. The last valuation is for the acquirer, because when you acquire the company, then you have to do an allocation of the assets. So how will you do that? I just explain through one process later on. And now, any questions on this before I move to the valuation part?
The last part, that is post-merger PPA, I think so they would be analyzing it in the first only, that what will be the acquirer's position. Post-merger.
So basically PPA is undertaken by the acquirer. You can analyze it obviously, but you have to account for it once it is done. So once you acquire the assets and liabilities and you pay some consideration, you have to see that what is the gap. You have acquired for 100, okay, and the book value, the net book value is say 50. So you have paid 50 extra. Now where do you allocate that? So you have to find the intangibles, identify it, and whatever you cannot identify goes to goodwill.
Okay.
So that accounting part actually takes place at the last for the acquirer.
So, okay. So when before doing the whole process, this is assumption that here there will be some cost, here this will be some cost. And after the whole process, all the costs are taken together for acquisition and then it is allocated.
No. So it's not about the cost. See, basically when you acquire a company, then what you acquire is the assets and liabilities represented on the balance sheet.
Right.
So on the acquisition date, you prepare a balance sheet. Suppose the net book value of the assets is 50 rupees. Okay. Now, when you are acquiring, you have to look into that. What is the fair value? Because if you look into Ind AS 103, that Ind AS 103 is business combinations. And business combinations say that you have to do an acquisition at a fair value. And when you do an acquisition at a fair value, that means that you have to consider the fair value of all the assets. Now, if there are, say there is a land and building, you have to do a fair valuation of that land and building. But there could be scenarios wherein even after doing the fair valuation of the assets, there will be some more amount that you have paid. Actually, why you have paid that amount is because of the intangibles, because of the brand, because of the network, because of the some kind of license, because of human resources, So you have paid for some technology. So you have to identify. So my thought here was that purchase price allocation is a process wherein once you do an M&A, the merger is done, then the acquirer has to account for the assets acquired at a fair value. And that is why the purchase price allocation is to be undertaken. I had just given one example also, which I'll cover in my valuation. It will help you in further clarification.
Okay.
So I'm just coming now to the valuation aspects. And see, typically, whatever valuation you are doing, you have to first understand the purpose of valuation. Why? If you don't understand the purpose, most likely you are not doing a right valuation, because purpose is the starting point basis which everything will drive. So based on the purpose, you will ask for the information. After that, you will analyze the company and you will perform certain normalization adjustments. You will understand the industry characteristics and trends. You will forecast and review. So when I say you will forecast, actually forecasting is the role of the management, not of a valuer. Reviewing is the role of a valuer. However, if it's an M&A deal, I mean, obviously, you have to segregate a statutory role and a non-statutory role. If we are doing only advisory, you can do forecasting, no problem. But if it's a statutory role, then forecasting has to come from the management. As a valuer, we will not do it. We will review it, sanitize it, adjust the risk premiums, and then accordingly do a valuation. And while we do the valuation, it is our role to decide the appropriate valuation methodologies. We should not go by what client is saying, and we should go by what is our judgment or our understanding of the subject and the industry and the opportunity. And after that, obviously, there will be some adjustments, there will be conclusion, documentation, and reporting. So I just thought that I'm not taking a valuation session, but just a typical process which we should follow for any kind of valuation. And if we are taking all the processes, all the steps here, maybe our valuation will be more authentic, that will come out. Now, specifically, the valuation which we are discussing here, the subject is M&A. So how do you do a valuation for an M&A? And we are restricting our discussion again to the NCLT approved scheme of arrangement. So the point number one is that the valuation is relative and not absolute. You are not supposed to choose one valuation methodology for unlisted company and choose another valuation methodology, there should be an apple to apple comparison. Most important thing, I mean, just as an example, you try to do a DCF for an unlisted company. Let us say there is a listed company. Listed company is frequently traded. So you can rely on the market price of the listed company. So you take market price for the listed company, and because unlisted company is infrequently traded, you apply a DCF for the unlisted company. In my view, that valuation may not be fair. The simple reason is that when you do a valuation for an unlisted company basis the future observable and unobservable inputs, the valuation most likely would come higher. When the valuation of unlisted company would come higher, then you would be issuing more shares of the listed companies, and it would not be, or it may not be fair and reasonable to the shareholders of the listed company. So there is an additional requirement that besides the valuation, which is relative valuation in case of scheme of arrangement, there should be a mandatory fairness opinion by a SEBI registered merchant banker. And the role of a merchant banker in a scheme of arrangement is that it reviews the valuation and it gives a specific recommendation that whether this valuation is fair and reasonable to the shareholders of the listed company. They do not want an opinion on unlisted companies because by and large, what is seen is that the unlisted companies are promoter companies which get merged into the listed companies. And so ultimately, sometimes, and we have seen this happen in the past, and that is why, SEBI strengthened on the valuation. Probably SEBI is the only body, regulatory body, which has recommended a format to be followed. Even IBBI, which has come out with valuation rules and all, they do not have a format that how you should present the valuation. They have given that, yes, you should see this and do this. There is a process that they have given, process of report is given, but how to conclude that report, Excel format, once you do. So SEBI has a specific recommendation that you have to mention that there are the 3 approaches, and we all know that there are only 3 approaches. So you have to mention the 3 approaches. You have to mention the name of the transferor company and the transferee company. You have to mention the value per share derived. You have to mention the weight given to them. And ultimately, you have to give a swap ratio with justifications. So if a valuer is not using an income approach, you have to explain. You are not using a market approach, you have to explain. You are not using an asset approach, you have to explain. So one thought which I wanted to make here was that there is a specific format which is given by SEBI, which you need to follow. Now, this format is there for quite some time now. So anybody who is doing valuation would be well aware of this. But certain changes which has happened recently, I would like to bring, because earlier it was the valuations were to be done by independent chartered accountant, but this SEBI master circular has come and now the valuation is to be done by IBBI registered valuer. And the only case wherein you can avoid or you can skip a valuation is if the shareholding pattern of a listed company is not getting changed. So if you are merging a wholly owned subsidiary into yourself, then it doesn't change your shareholding pattern. If there are no external shareholders, so that is one situation wherein you do not require a valuation. Other than in all situations, you require a valuation. One doubt. I'll give me a minute. Let me just complete. Yeah. One important change, and anybody who would have done valuation in 2022 would be knowing this, that earlier the rule was that the valuation of a listed company, minimum valuation will be the valuation as per SEBI preferential allotment guidelines. Now that preferential allotment guidelines used to give a 26 weeks and 2 weeks average price, high and low weekly average price we had to compute, and basis that the valuation had to be done. Now recently from 14th of January 2022, the change which is done is that 26 weeks and 2 weeks weekly high and low has been changed to 90 days and 10 days. And it is 90 days and 10 trading days volume weighted average price. So earlier, the way the valuation used to happen was that the valuation, for that valuation purpose, you had to take the closing price for weeks, and you have every week you have to take a highest price and lowest price, and then basis that a 26 weeks and 2 weeks average used to be done. Now it's a significant change, and I have seen a number of reports which are still not complying with this change, and the exchanges are not approving the scheme of arrangement. And the change here is that you do not have to go 26 weeks and 2 weeks. You have to go first 90 days, 90 trading days and 10 trading days. Second, you have to consider the volume weighted average price and not the closing price. And third important point here is that how do you calculate the volume weighted average price? So this, I want to discuss this. If any of you have done recently any merger valuation, please share your experience that how do you calculate the volume weighted average price for the SEBI preferential allotment guidelines. People who have done it, please share your experience. So nobody has done recently the SEBI any preferential allotment valuation or a valuation for, yeah, I think Kusum, you have raised hands.
I have raised hand for a different purposes.
For a question. Okay. So I'll come back to you. Okay. So I'll just tell you. So see that the cause of dispute here is that earlier we used to average out that 26 weeks and 2 weeks. Now the law has changed. The law has not used the term average. The law has used 90 and 10 trading days volume weighted average price. So, and in fact, what happened that this regulation came in January, but in March, there was a clarification given by NSE. And what is the clarification? That if we go on NSE site or BSE site, then there is a total turnover option and there is a total trading option. So we have to total the turnover for the 90 days and divided by the number of shares traded in the 90 days. Similarly, we have to take the total turnover of 10 days and we have to divide it by the total number of trading happened in the last 10 days. And that is a precise formula which we have to use. So anybody doing valuation for listed companies using preferential allotment or through M&A, you please make sure that you follow the correct approach, because this is where valuers are doing mistakes. And good part about this is that, all of these valuations are available in public domain. So you can see that, different valuers are using, some people are still averaging and some are using this. But recently we faced a case wherein, this point was particularly raised by the regulator also. So if you have used the correct methodology, then the scheme is getting approved. Otherwise, there are questions. And one more point which I want to raise here is that typically when we do a listed company valuation, then listed companies, now what is the relevant date? Till which date you have to consider this 90 days and 10 trading days. So that date precisely is the date of board meeting in which your scheme is getting approved. So if your scheme is getting approved today, then you have to take this till yesterday. So generally we do valuation and we give it to companies and then company do their board meeting later on, okay, for unlisted companies. But when it comes to listed companies, you have to update it till one day. So if there is board meeting tomorrow morning, 11 o'clock, then you have to wait for the closing price, because this VWAP you cannot calculate. VWAP, total turnover, only stock exchange has to disseminate. So 6:30 p.m. it will be disseminated. You have to work late night that day for your client, and then you have to update that for the listed companies. One important question: is there any guideline on the date of financials for unlisted companies? Because we see for regulatory valuations, we have seen that, sometimes these mergers keep valuation date of 1st of April. So like if I keep 1st of April 21, even the valuation date, sometimes it is kept 1st of April 21, which is done on the basis of the financials of 31st March 21. But recently, the stock exchanges have issued an SOP that if you are doing a valuation, then your date of financial should not be 3 months older. So when I am doing valuation, so let us take an example that if I am doing valuation right now, so the date of financial should be 31st of March, because I am sitting in May. So I cannot derive on financials which are more than 3 months old. Now there is a little bit of confusion, because what they have done, that they have said that if you are using income approach, you can use a 6-month-old financials. If you are using any approach other than income approach, then not more than 3 months old financials, in my view, because it is not prudent to use different dates of valuation. We have to first define a date of valuation. So date of valuation cannot be for different methodologies different. So that is why what we are doing, that we are not doing any valuation for a listed company, in which unlisted company is valued based on financials which are more than 3-year-old or 3 months old. I'm sorry, 3 months old. So these are few important changes which has happened. So be particular when you are valuing listed companies, because there are stakes involved, there are minority shareholders involved, and this is my submission on particular this. Yeah, Kusum and any other person who want to discuss, please.
For Kusum, Chander, see, when you are doing for unlisted companies, we will take the valuation date as appointed date, the merger date. Okay, not this 3 months or 1 month. Because if, for example, today I'm doing like 28th May 2022, maybe my merger appointed date is 1st April 2021. Then the valuation, we should do that 1/4/2021, the appointed date. I cannot do it for 1/4/2022.
No, sir, my view is different here. Appointed date and valuation date can be same or can be different. There are judicial pronouncements, because what happens that, you know, in case of merger, we can decide on an old date, right? But practically, see, you look at it that it is not a related party. It is not a group company. If it is a group company, you can take any date. It does not bother you. If suppose you and me are unrelated party, and you and me are doing into a scheme of arrangement, I am acquiring your business. Okay. I will not give you the money of assets which were there 1 year back. I will prepare a balance sheet today, and I will look into that. Suppose you had a land 1 year back, and you have sold that land and you have withdrawn that money. Will I pay you for that?
Correct.
So valuation date, commercially speaking, should be the date of transaction. It cannot be an older date, because a lot of group companies merger used to happen, and it does not matter whether you use a valuation date old or now. So we have seen that, yes, in case of group companies valuation, which are not listed companies, I emphasize, which are not listed companies, you can take appointed date also. But you have to be clear that, you know, it should not be, if there is no change in assets and liabilities, if there is not much change in the income and profitability, the valuation will not materially differ. Correct?
Yeah.
However, what I want to make here is that for listed companies, SEBI is coming out with its own norms. And today, if you are valuing an unlisted company which is getting merged into a listed company, you cannot take its financials older than 3 months, irrespective of the appointed date. Appointed date has no relevance in this.
See, if you have any material impact, okay, selling the asset, maybe I don't take the old date, like 1/4/2021. Instead of that, now I'm in May, I can take it like 1/4/2022, because last year they might have sold some companies. But usually the NCLT or accept, okay, only the appointed date. As on the appointed date, what is the price of the company, the price of the exchange ratio that we are supposed to give. I believe that, because even we have done recently one where the appointed date is 1/4/2021. We have given the valuation as 1/4/2021 now.
Well, that is what I am trying to convey, that in unlisted companies, there are no such regulatory provisions.
Yes.
So because there are no such regulatory provisions, so you have an option to take different things, and that too also, please remember that every NCLT is different. So the processes which are used by NCLT are also, the NCLT of Delhi and NCLT of Bangalore may be taking different views.
Yes.
Because there are no regulations.
Yes.
So we can only discuss about the regulations, and for listed companies, there are specific regulations. However, if there are no regulations, then my view is that we should look into the commercial perspective. And commercial perspective is that, if you are buying something, okay, you are accounting it from 1 year back. That is a different thing. But you are buying only something which exists today. So valuation should always be on the date of, there has to be a cutoff date when both the parties agree that yes, we are making the transaction. So, and that point of time, basically, the valuation should be undertaken. However, one important role understanding is that what to whom is this transaction affecting? So if there is common promoter, typically Venkat, the kind of transaction you are mentioning, I am sure there would be common promoters in those transactions.
Yes, there are common promoters.
So common promoters, common management, it will not impact them whether you issue 2 shares or 200 shares, right?
Yes.
That is why we can take different dates also, and we have also done valuations wherein we have taken the appointed date. But when we are doing actually valuation, the way SEBI is looking at it is that you have to look into the current trend of the situation. You cannot look what happened 1 year back, because you look into, for listed company, we are taking the price 1 day before the board meeting. So that is, I mean, you cannot take a value an unlisted company, because unlisted company has to prepare financials. So that is why they kept this information of 3 months, that you cannot take any number and base your valuation if that is older than 3 months.
Chander, if I can share my experience, Venkat, we have also done one unlisted companies merger valuation last year. Due to some as on 31st March 2021, due to delay in filing the document, they could not they did not file it before 31st March. Now they are filing now. They decided saying that since NCLT may not approve based on the 12 months old transaction, they said you prepare the unaudited provision affairs for the current year 2021, 22, then you go in. So again, we have to reevaluate entire valuation process, and we issued point number 1. Point number 2 is absolutely, as we discussed, there is a difference between appointed date and valuation date. Appointed date is only for date for compliances and mergers, for merging of all the numbers. As is very clear told, valuation is very important. Every day keep changing the transaction. So valuation date and appointed date can be different. And valuation date, normally NCLT, they said they will not accept the numbers are older than 6 months, even for unlisted companies. So based on our advisor's session, we have to revise the valuation report.
Actually, there are, see this 6 months thing which you are saying, this 6 month thing is not for valuation, but you have to file in NCLT the latest financials, which should not be older than 6 months. So yes, in case of unlisted companies, the valuation generally, I mean, if there is some stipulation that yes, you can say that, and in general also, we recommend to client that generally do not go for financials which are older than 6 months, right? So that is a suggested route. I agree.
No, I think I tried to asking about this relative valuation or absolute valuation. What is exactly the difference between relative and absolute valuation? Is it like that? If income approach, if I'm using for transfer company, we have to use income approach only for transferring company, or what is the difference between absolute and relative approach in the context of merger?
So for this purpose, basically, it is essentially an apple to apple comparison. I gave you an example that, if you look into the methodologies, and different methodologies result in different numbers. And why so? Give me an example. If you have to buy shares of Reliance Industries today, okay, can you buy 100 shares from the market?
I can buy.
Okay. Can you buy 51% shares from the market?
No.
No. So 51% has an element of control, right?
Yes.
And 100 share does not matter to anybody.
Yes.
So the market price is actually a minority price. When you are buying and selling from the market, it is not a controlling price. If you look into any company which is getting acquired, the open offer when comes gives a higher price. And if you study, then there is typically a control premium of 25 to 40% over and above the ruling market price. If there is any news that this company is getting acquired, the share price raises by 10%, 20%, 2-3 upper circuits. Because the control element comes into the pricing. But when we do a DCF valuation is a fundamental cash flow based valuation, which is inherently a control valuation. So in general, a DCF valuation will throw a higher value than a comparable valuation. That is why I am saying that, because the idea is to do a relative valuation. So if you are doing a DCF for unlisted, you have to do a DCF for listed also.
Chander, since you are talking about DCF, here I have one question. When I'm taking the income projections, as a transferee company, do I need to take the transferor company projections also into consideration for next 5 years? As if the company is going to merge with us, then I need to take into consideration or not?
See, you are working on standalone basis. Okay. So you are not taking the impact. You are not taking the impact of the merger when you are valuing. You are valuing the transferor company on a standalone basis and the transferee company on a standalone basis. The benefits of merger are not being taken into account. The problem here is that we have seen some valuers doing that. You value the transferor company on the basis of projections, but you say that for transferee company, it is price sensitive information and I cannot do projections. So that is why I have taken a market price for transferee company. So the problem in that scenario is that you are actually giving higher number of shares to the transferor company shareholders. And who are those shareholders? Actually, the promoters. So the fairness, in my view, the fairness should not be given to those schemes until and unless, those can be, there should be a very strong reason or those can be substantiated.
Okay. You mean like you need not to take into consideration of transfer company projections into transferring?
No. So I am saying that first of all, you can do projections. There is no problem. But you cannot do projection of one and not do of other. That's what I'm saying.
Okay.
Projection method you can always apply. Nobody is saying you cannot do it.
Got it.
By standalone method, you mean that it is independent and there is no swap ratio decided in the valuation report?
So by standalone, I mean that the way the transferor company is operating and the way the transferee company is operating without taking any impact of the synergies of the businesses. You don't have to merge it. You have to look at it as if they are independent companies, do an independent valuation and then recommend a swap ratio.
Okay.
Any thoughts on this weights? Assuming that I'm doing an unlisted company, market approach is not applicable. Income approach and asset approach. When we are assigning the weights, is it maybe 70-30 or 60-40? Any logics? What is any guidance? Assuming that I have one company where that.
Yeah, I'll address. See, when you are valuing an unlisted company or a listed company for that sake, whenever you do a business valuation, you have to give weight to the business, first of all. Okay. So typically we do not give much weight to the asset approach. Why? Because asset is not resulting into the cash flows. The business, when you do a valuation, then valuation, what is the value driver? The value driver is your cash flows. I mentioned it at the first slide itself, right? So you have to look into and for unlisted companies, even though there is no market price, but there are comparable companies, no? So you have to do a comparable assessment of the unlisted companies vis-a-vis the listed companies or vis-a-vis certain transactions which are taking place in the market, and that will give you a valuation, and then you can follow another discounted cash flow that will give you another valuation, and you have to do a synergy, you have to do a reconciliation of value. I mean, see, valuation methods they will give different numbers, but the numbers should converge. So you have to understand that if one number is giving you a 10 value and another is giving 70 value, then there is some problem. Maybe the cash flows are aggressive. Okay. But in general, we give more weights to the income approach and market approach. And either we ignore the asset approach or we give very less weight to asset approach unless and until we are valuing a manufacturing company wherein there are manufacturing companies, steel plant, power plant, wherein the assets have a reasonable value. Okay, you cannot value an IT company on asset approach. There won't be anything. You cannot value a toll company on asset approach. So generally, for going concern basis, we do not have to liquidate the assets. So that is why asset approach is not relevant. Having said that, if you are valuing an IBC company, a company into liquidation, you cannot use an income approach. You have to look into the asset approach, and then that if for valuation of an asset you need to use an income approach, that is possible. But you have to value specific assets during an IBC and not cash flows basis. That is basically how you need to do it.
Yeah, you also mentioned about fairness opinion, and you told that it is merchant bankers who actually issue the fairness opinion. So is that a case where a valuation report is issued by a registered valuer and a fairness opinion is issued by a merchant banker, and then this reconciliation happens between the valuation report of a registered valuer and the opinion of that of a merchant banker?
No. So reconciliation valuer has to do. Okay. Merchant banker has to just say one line whether this valuation is fair and reasonable to the shareholders of the transferring company or not. That's it. Merchant banker is not doing valuation. Merchant banker is just using his experience and judgment to opine that whether this valuation is fair or not.
Yeah, but in the fairness opinion, he will also have to so is my understanding correct that he will be giving a fairness opinion on the valuation that has been conducted by a registered valuer? That's my first question?
Yes.
Okay. So if when the valuer is has prepared a valuation report, there will be some inherent assumptions that he would have made, and without those assumptions, the valuation would not have the value would not have been arrived or derived. So in that case, would it be that the merchant banker will actually go in and review the assumptions that have been made, because until he reviews the assumptions, he will not be able to give an
so merchant banker is given all the entire workings and everything. Merchant banker can discuss with the valuer, and see, ultimately the idea is not to go so deep dive that why have you taken 16.43 and why you have not taken 16.5. Okay, so because an independent value, see, if merchant banker performs an independent valuations, the number can be different. We have to accept that because there are different valuers. So the merchant banker role is not to do an independent valuation. The merchant banker role is to see that there is a process which is followed, and whether that process and prima facie there is anything which is coming to the notice that this valuation is not proper. And I gave you an example that if for one company you are using a control method, another company you are using a minority method. Principally, that's a question. Okay. But yes, you can I don't think that, there a merchant banker would be going into, he will be respecting the independent opinion of the valuer that yes, this is my view. And basis that he has to look into that the macro situation is right. And if that is right, I think he gives a fairness opinion.
Kusum, if any difference in opinion, then we need to change our approach or our calculation as per, okay, then mutually consent will go ahead. It is not that, okay, afterwards, again, they will reject it and it will go happen both simultaneously.
So if there is a difference of opinion, one of them will have to.
Obviously, it needs to be reconsidered.
Yeah, I will give an example. Okay, in one of my case, okay, the capital expenditure we estimated for 5 years and what they estimated 5 years are different. The capital expenditure. Then, okay, the company again we have one meeting and again we sorted out that. Okay, what is the
they who are they? I mean, they estimated. See, because when you have to place reliance on the management spend of capital expenditure over the next 5 years, right?
Yes, yes.
So that would have been the basis for you as a valuer. When you say they who are
See, the management has given the last year the capital expenditure as 0, which okay, as a valuer they have given assumption that, okay, like we don't have any capital expenditure, we are going for AMC, which the merchant banker is not accepted in that case. No, there will be a expenditure. It will not be a 0.
So generally, see what happens that before the sign off of the valuation, the view of the merchant banker is also taken.
Yes.
That this is a draft working which is done. If you have any view, you can share your view. And the merchant banker, if he is okay, then, he approves. Otherwise, he can give us perspective. So before sign off, a draft is shared with the merchant banker in confidence. And then, because otherwise it will be very difficult if a valuation is signed off. And otherwise also, what happens typically here, the date of valuation and date of fairness is both on the date of the board meeting only. So the signing only takes place on the date of board meeting. So till then, these are only draft. So if there is any gap, they have to discuss and reconcile.
Yeah.
Just to get just one more clarification. So this merchant banker's fairness opinion is required only in case of a listed company acquisition, mergers and acquisitions, right?
Correct.
Okay, thanks.
Chander, we have very less time. Okay, we can go ahead. Next.
Just one clarification. I'm just confused when you say when I'm using a DCF method for an unlisted entity, I have to use a similar methodology for a listed entity to apple comparison. But the SEBI regulation doesn't allow me to use a similar methodology. It mandates a particular methodology for a listed entity. So can you just clarify on that?
That's a minimum methodology. That the understanding is that whatever is the price which you are getting through market approach, okay, that is the minimum price. So long as, see, very simple. If you are increasing the valuation of a listed company, okay, then there is no problem. Because when you are increasing the value of listed company, you are reducing the value of unlisted company. So you are issuing less shares to them. So the simple way of looking the fairness is that we should be comfortable that it is not prejudicial to the interest of the public shareholders of the list. So public is not there in unlisted, public is there in listed. So either you have to look into two things. Listed company price should be more than the market price, one, and the unlisted company price should not be significantly higher. Okay. So if you do, and sometimes when a merchant banker opines, because we play the role of a merchant banker as well and fairness as well. So when a merchant banker opines, the idea is that so long as you are meeting the criteria of the minimum pricing and you are there, you will be seeing a lot of valuation, wherein listed company valuation, if the market price is 100, the valuers have arrived at the market price as 150 rupees for listed companies. And so long as it is higher than the minimum stipulated price, it is good to go.
Okay, understood. And just on the valuation date, you said for the listed entity, we have to take 1 day prior to the board meeting date. then should the valuation date for the unlisted company also be 1 day prior to the board meeting date?
I mentioned it that it can be based on the last 3 months financials, because there is no pricing which is available, right?
Yeah, financials I understood that 3 months, but
Yeah, so market
valuation
price,
date specific.
if you do a comparable market valuation, then yes, you can take the market price. Suppose you are using a methodology EV/EBITDA multiple, then that price for that EV/EBITDA can be the same board meeting date. Yes.
Understood. Okay, thank you.
And there cannot be a vast difference between income approach and market approach valuations. Did you mention that?
Yeah.
And if there is a vast difference, then
you have to deep dive. You have to understand why is it coming. I mean, say there could be a 25 to 40% difference. Considering that the nature of these two approaches are different. But if the difference is coming, say 100%, then something is fishy.
But see, normally when we are going with a market approach, it's multiple that we are using. So there is a possibility that there is one very advanced and developed company in the same domain, in the same industry sector. And this is one which has been 5 years around. And so when this type of comparison is being done, should we at all take it up?
Take it up in terms of
market approach?
So see, again, I mean, see, market in Gujarati, they say Bajar Bhagwan Che. What does that mean? That, you know, market knows it all. So market factors into, I mean, so when if you are holding a share and you want to sell it, and tomorrow market will be down, and you want to buy it, then market will be up. So market factors futuristic things. If you study the trend of the market, then why there is so much of volatility? Because market is worried of what is going to happen. So market moves 2 steps ahead of us. So now the point is that if something is available in the market at an X price, why should I pay a Y price or X plus plus plus? Why should I pay that? So market is always a benchmark of what is going on. That is why if you do a DCF and you say, no, market will not affect me and I will be 200% growth and this, that, investor will not buy that.
No, growth is also not 200%. Growth is also sustainable thing, but still
then
there is a vast difference.
Then it should, so see, it's a fact specific discussion again. Ideally, the theory of valuation guides us that the valuations must converge. If they are not converging, you need to deep dive.
Okay.
Nothing more we can discuss at this point.
Okay. Yeah, thanks.
You can discuss in person if offline if you want to discuss.
Sure. Yeah, thank you.
So I think our time is up, but any questions have, I mean, I can continue. And just, Kiran, just give me a minute. I'll just work. So this is a purchase price allocation slide that I just mentioned earlier. So let us say that, you know, the book value is of 47 and the fair value of 47 is 273. Okay. And the price is paid is 1398. So what does that mean? Is that there is these intangibles which are accounted: technology, trade name, consumer contract name, non-compete. Okay. So this was one slide I wanted to show you about purchase price. And that's it from my side. This is my email address. I can circulate the presentation, my details. So happy to discuss any more.
Yeah. Any questions from the members?
Venkat, I have one question on this purchase PPA. Sir, this for purchase price allocation, is there any accounting standard requirement or is there any guidance note?
So there are 2 things. One is there is Indian accounting standard on intangible assets. And second, there is some guidance in IBSC. Okay, so there are five kind of intangible assets: technology-based, customer-based, brand-based, artistic, right? So first of all, you have to identify that and then you need to value. But there are two guidance which are there in the accounting standard and also in the IBSC. IBSC has a particular, I think 210 is the number, I don't recall.
103.
Yeah,
Business combination.
No. I'm not talking of intangible assets. I'm talking of IBSC. I think IBSC has 210. So 103 is accounting standard in days, but International Valuation Standard Council also guides on the valuation.
When acquiring transfer company acquires business of a transferor, whether they have to recognize all the assets at book value or fair value.
So if your company is a company wherein you Ind AS is applied, then you have to mandatorily do it at a fair value. And that is why there are a lot of valuation requirements for PP. Not for smaller companies.
Last difference is the difference between purchase price paid and also fair valuation will be recognized as intangible or some amount is a goodwill. That goodwill since it's paid goodwill, it is recognized in the books over a period of time. It will be and based on the fair value, it will be written off. And income tax, we can't get the depreciation, no?
Now that's a different topic altogether.
Okay. Thank you.
Chander, see, when we are doing a PPA, so the deferred tax assets and liabilities has to be put it in the report itself, or whether we need to compute. See, when we are doing some consideration, we are allocating to various intangible assets. Okay, so leftover is a goodwill. So while I'm doing, so I even deferred tax also needs to be reported, or how it is generally it is happening.
Yeah, so you have to look into, I mean, if you consider that is because, see, deferred tax asset is generally accounted for on a conservative basis.
Correct.
Now, if deferred tax is there, that means that probably there are some losses. And you are going to, now you have to look into that because you have acquired that company. Will you get the benefit of those losses or not? Because there could be change of 51% shareholding and section 79 does not allow you to carry forward those losses.
Yeah, agree, but generally in the valuation report, see, we will restrict normally with the consideration, if contingent consideration is there, and the other intangible assets, we are going to fair value, and we are giving only to that extent, and what are the tab benefit, tax amortization benefit is there, to that extent I am just restricting as part of my valuation report, but I am not considering any of the deferred tax assets and liabilities, the impact. So whether should be normally in the general practice, how it is.
Yeah, so I mean, if it's not an asset which you are acquiring, the question is whether you are acquiring that or not. Can you get it legally? Because
I understood.
Because intangible, there is a definition that intangible asset should be identifiable. It should be separately identifiable and
control,
and it should be legally also. I mean, there are characteristics that you must be able to identify, and it should be legally, like let me give you an example that you can value an employee
assembled workforce,
assembled workforce, but you cannot account for it.
Yeah, I understood. That's why it will be subsumed into a goodwill. So I cannot recognize as a part of the assembled workforce.
It gets embedded in the goodwill.
Goodwill, correct, agree. So I suppose in my case, it is a customer relationship, I got it. And also it is a technology, and also it is some part of other intangibles which has been generated. So while I'm doing, I have done a PPA allocation, everything, but the question is that this deferred tax asset and liability on the first day, on the acquisition date itself, whether I should value and I should give that number also part of the valuation report, where I got confused.
So again, I think I have answered it.
Yeah. Okay.
Thanks everyone for patiently listening to our sessions. I request Mr. Subbarao, our president, to formally convey a vote of thanks for today's speaker. You're on mute, Subbarao.
Thank you, Shilpa. Thank you, Mr. Chander. First of all, accepting our request to take a session on trends and challenges in mergers and acquisition. It is very apt in this situation where a lot of mergers and acquisitions are happening, And also it is beneficial to the both companies, whether transferee companies and transferee companies, which Chander covered, okay, from importance of merger, then the Ukraine impact, then Indian startup trend, okay, where a lot of mergers and acquisitions are happening from startup side, and also focus, okay, shifting to companies with profitability, where mergers is going to happen, like merger and acquisition trends. And okay, he has covered again the mergers acquisition roadmap and why the mergers and acquisition, which is very, very important. And he has covered the applicable laws from Companies Act, FEMA, Stamp Act, from SEBI. Is very, very important, not only as a registered valuer, it is very, very important as a company secretary or chartered accountant or cost accountant, which will revise everything what we do, regular activities in mergers and acquisition. And role of professional. The role of professional as a valuer, everybody knows that before any merger and acquisition, the first step is a valuation. As a valuer, and not only a valuer, and we are chartered accountant or company secretary, where we can give more services, not only under valuation, maybe under Income Tax Act or under corporate laws. Unless you get the assignment from a company secretary or advocate, you can give more access to the promoter, then you can get more business from them also. And key issues in merger, that is very, very important, and demerger, which is very helpful, and merger and demerger regulatory processes. And at last, okay, the Chander has covered the valuation accepts, which again recent 910, that is very, very important for everyone. How do the valuation in case of unlisted companies, listed companies, and income approach, asset approach. It is very, very important for as a valuer when you are doing under mergers and acquisition. Thank you, Chander. Thank you very much for your full cover. Like, we have given a full meals to us, not only valuation. You have given rules and regulations, the process, the trends, everything you have covered, and the trends and challenges. Thank you very much.
On
Thank you,
behalf
Chander.
of all the participants, I request the speaker to please share your PPT. Indeed, it is really, wonderful. I was so tempted to tell you about Excel case study and all of that. Thanks for taking it up, this way. We are really, blessed to hear you.
And I request the participant BV members, okay, like the sessions which, okay, you are looking into more on topics, then which will help us, okay, to provide you to bring the new professors or the speakers. And also, like, we have given the feedback form also, please fill the feedback form once this session is completed. Thank you.
Thank you. Thank you so much, everyone. Yeah.
Thank you. Yeah. Have a good
weekend. Yeah.
Thank you, BDA. Thank you, Mr. Chander, Sawhney. Thank you very much. Have a good day.